So welcome again. We have seen how DCA works, the use of market depth, and also good till date GTD orders, and also how to amend orders. I'll be now doing. After I'm done with the next 2 or 3 videos, which are a bit theoretical. Then we go into practicals. Now that market is down. My name is Peter Chega. That's my WhatsApp number in case you want to reach out. So what is a GTD order? This is just a recap. The GTD order is good till date. These are orders that you place on broker platform, specifically a BDG trader, and you give it number of days. Good till date means you're giving your order live, we call it live in the market for number of days. So every day the broker will keep on refreshing without you having to put the order. Either it executes in between, it expires because of maybe it is out of range in terms of price, or it is cancelled on the date you put on the system if it doesn't execute, or you cancel yourself or amend. So that's what is called good till date, and it is under validity. You remove the day, you put GTD. There is that option. I will come to that practical. Then you give the calendar date that you can find on AIB DigiTrader from AIB Access. That's where I work. So whatever we have been learning on this channel is straight from the market. I have 20 plus years in the market. So think of GTD like telling a shopkeeper, I want to buy this item, only you reduce the price. If not today, I'll come tomorrow or even next week. It's the same thing. What you're telling the sellers, I will only buy when you come down to my price. I've given you enough days. When you come to that price, just give me the shares. So on NSE, you're telling the system the price you want. So you put a limit, then the price. Then under validity, you select GTD number of days. That price, as we have seen previously, where you are trying to take advantage of lower prices, would be higher than the strongest demand, but lower than the current demand, or even same as highest bid or demand if market is balanced. If my buy side is weak, that is the market is controlled by the sellers, then you want to lower your price. You don't want to buy at higher prices. So your order stays for days or weeks until the price comes down. If price now starts falling towards your price, you may get, it can even happen during the day. Remember what I said in the previous videos where we discussed the chaos window. In the morning, there are orders called market orders. They are submitted from 9:30. You can't do a market order between 9 and 9:30. You can only do from 9:30 to 3 p.m. when market is open, or when market closes 3 to the following working day. So the difference is when you place between 9:30 and 3 p.m., your order goes straight to the market. It picks whatever is available. Remember what I said, between 9:30 and 11, that window is very risky. That's when the market is trying to stabilize, getting the right prices. And at 11, that's when now serious investors, and serious here I mean people who watch the market, not those who are chasing the prices, come in the market. Foreigners, that's when they start coming in. Fund managers, that's when they start coming in. They have watched your moves in the morning when you are playing with the market orders, when previous days orders are being parked and they have seen the trade and they have made a decision. Do they want to get in early or do they wait for the prices to come down? So during that window, market orders come and clear out. So if you had put a GTD order at a lower price within the range of 10%, there are chances that you may get. There are people who don't care about the prices. You come and float 1 million shares at best because you want to sell in India. That can come and clear everything. And there are likely chances that you can get during that window. But it is also risky. Market could be going down and you execute your order at a higher price where the market is also dipping. This may happen if you have left GTD order without checking the prices. Always check the prices. If you are putting a GTD for many days, it is at lower prices, not at higher bid prices. If it is at higher prices, you need to keep on watching the market so that you don't execute at high prices. So it only buys if sellers accept your price. So in this time, you're not rushing, you're just waiting for the discounts. So relatable examples. Good example, you want to buy tomatoes at 200. When you know they sometimes go all the way to 150. So you say, if they reach 150, I'll buy. So you keep on coming to the market, check, have it gone down? Maybe it's that season where there is low supply of tomatoes and you're seeing prices have started to fall. So you put your limit, I'll buy on it at 150. So when it comes to 150, then you exactly buy. That's exactly what GTD does for shares. You're putting lower prices, waiting for the prices to come down, then it executes. But this time it is the system that does for you. So how then do DCA and GTD work together? DCA, dollar cost averaging, we said we are trying to lower cost by spreading buys over time and buying at lower prices every time. Then GTD is good trade data. So what DCA says, don't spend all your money at once. Buy slow, bit by bit, at lower prices, because you are trying to average your cost down. What GTD says, I will not buy expensive. I will wait for better ones. So I will not spend all money at once. I am waiting to lower my cost. Then how do I lower? I will spread my buys over time. I put my order to be in the market for some time. I will not buy it expensive. I'm waiting for lower prices. So when you combine both, what you're basically saying, I will invest small amount. I only buy when prices come down, and I'll give the market time. So I'll keep on buying slowly. When prices come down, I will buy small shares. If they continue, because this market is not predictable. Even in this holiday, even if I'm telling you prices will come down, they will not go down with that significant figure. Only the shares that have been hyped will fall with a huge margin. And these are shares that then stagnate for the longest. I don't foresee a scenario where some of these stocks will go back, especially penny stocks. So these may work only with stable stocks, which prices just fluctuate a bit, then they recover. Right now, this holiday, around February, companies start to announce the results. That's when prices will start to rally up as people try to lock in dividends. So you want this time, every time there is a drop, you buy some. If you have bought, again you wait. If price also drops further down from your price, you also buy. However, if you are limited in terms of funds, when prices come down and you anticipate it will go further down, you adjust your order down. So it all depends on what you're looking for in the market. So you stop panicking, you stop chasing prices, and you start buying smarter. So a good example, like currently Safaricom is around 28. It keeps on fluctuating between 27 and 29. And currently it goes, unfortunately, the government must cap that price below 30. Make the deal where they are selling part of their shareholding. Remember, Safaricom is owned 25% by the people who trade at NSE. So whatever trades at NSE is 25%. Then Vodacom and government owns the other portion of around 75. So out of that 75, the government owns 35 and Vodacom owns 40%. So government is selling part of their 35% is what they are selling. They are selling 15, they bid after it's 20, then they give that to Vodacom, which increases now to, is it 55? Yes, 55%. That has no effect to you as a shareholder. Remember, your 25% is not touched. It only affects the government. And the reason why you hear that noise outside there is because people want to you to believe that government is you, me, and the other person. That's why they're making that noise. But remember, as a shareholder, you have your own shareholding where you put your money. That's what you should be concerned on. not what government is saying. It has no effect on your shares. You still retain your 25%. Government retains 20%. In the sale agreement, they have already said they want a Kenyan in the top management CEO. So you don't expect, even if Vodacom has the highest say with 55%, government still retains some rights. Your dividend are not touched. Actually, this is the best thing that has happened to Safaricom. It's only that politics are coming in. The reason is you find now decisions that are made are not aligned to government. They are aligned to the shareholders, which is the right decision. So that's why Safaricom is trading at 28, and it is a good opportunity for you to get in. If government was not interfering with these prices, it would go to 40, 50. It would be above 40. Just ask yourself, why did it go to 40, then all of a sudden went to 28, then there is a sale, like government always sees. And there are many other stocks that are controlled. KPLC, prices are stuck. Like yesterday, there was no supply, but the bids had not blocked supply. Why? We have KPC, IPO coming. Don't get hyped to some of these stocks. Always watch out for these things. Some things are there in public. You don't need even to be told. When you see some things happen, you know who is controlling. So let's go back to Safaricom. Current price 28. What most beginners do, when you see 28, you panic. When you see the prices start going down, you panic. You want to buy immediately. Let me buy before it goes up, because you are panicking. But if you look at the signal, the market may be going down. You have noticed the market is going down. But as a beginner, you think this price is not sustainable to go up. Let me pick right now. But the market is still going down. That is emotional buying. Don't invest with emotions tendency. Don't invest using social media. Use facts, what you can see, and what credible research sources give you. Most brokers, they do that. NSE, CMA, CDSE, they do that. Always rely on those information. Any other information, do extra research. I'm seeing a shift in social media, which sometimes I feel hurt, and that's why I always talk about this in my videos. You hype a stock, you know it is a dead stock, it's a penny stock, people buy, you're the one selling. When you have sold and you have left, now you want to confuse people with other terminologies. Please watch out on what happens on social media, because the emotional buying that is happening on social media will left many people cash strapped with the stocks they can't sell. And that's the reality. And at the end of this video, I hope I remember, I'll tell you how to know ChatGPT generated information. It's straightforward, you can tell. So then what smart DCA and GTD investors do, you say Safaricom is a good company, but 28 is expensive for me. It's a good company. At 28, I can't buy. I can only buy at around 27 because I can see there is a trade. How do you know the trade? The previous video I said what? You look where the strongest selling power is. If it concentrates at the top and the sellers are more than the buyers, that is terms of quantity, there is a selling pressure and go down. Then you also check the next strongest bid. Where is it? Is it at the top, at the highest bid, or lower? If it is lower, then that tells you that price will go down. Because more people are willing to sell than buy side. So you place your order down at 27, give it some days. You don't watch the screen daily. You continue with your work, and when prices come down, you hit your price. You only maybe people once in a while, or in AIB, DigiTrader, and also put up this price alert. Just check for that function. I'll show you in the next. I've also done a full video. There's price alert. You just put price alert. When price comes to 27, trigger that notification. You'll actually know when shares are executing. You can even put multiple when it reaches 27.5 trigger me, so that time you can check how the market is still performing, so that you know whether you still. And just remember, in the previous one, we said you have made your price down. No? So if price goes to 27, the order automatically executes. And remember, you are not buying everything. Yeah? You have just put a small order. So you buy Safaricom at discount, no stress. If price doesn't drop, then you still wait, because this market moves, especially right now. Only when there are corporate actions like dividends which are active, that's only time you need to buy immediately. For the other times, watch the market. So you wait. If price doesn't drop, you wait or amend the order later. You have not forced yourself to buy the fat form. So you continue like that, and over time you realize you are lowering your cost. The next month, maybe the price have gone to 26. You buy. So price doesn't, if it doesn't, then you still have to wait. There is no hurry in the market. Then over time, you correct shares at lower and lower prices. What does that do? DCA, dollar cost averaging. If you have to do the total cost for the shares you have bought, divided by the number of shares you have bought. So the total cost incurred by each share, sum that, divided by the number of shares, you get average cost, which is lower. So you're not chasing prices, you are correcting shares cheaply. It's like buying food in bulk during discounts. And when prices go down further, that time pump a lot of money, buy all those shares. Why this works well? First of all, GTD removes emotions. You are not panicking. No fear of missing out and no regrets. And as I said, when you see your portfolio in red, don't panic. This market, it goes up and down. Prices will never be up. At one point, they will recover. If you're those investors who are chasing prices, sell when it is green. When your portfolio is in profit, sell so that you stop panic. If you're investing long term, then don't check on profits. You just accumulate dividends. DCA, on the other hand, spreads risk. You don't go all in, you reduce losses if prices go down. So both of them together, they work to lower your average cost. You want to lower your average cost as much as you can. Even if you bought when prices were high, don't panic, buy now. You will see in the average cost it will start coming down. And as I said, if you have ever transferred shares from one broker to another, make sure you give them the portfolio valuation from the other broker. They update that valuation list for you so that you get the correct average cost. If there have been bonuses and splits, make sure your stocks are updated. Fortunately for AIB, I usually do that for the bonuses and maybe where there is splits. When they do happen, we have not had any splits of late, but splits, they don't change your portfolio a lot. It's only bonus, because the bonus shares comes without a cost. So you need to factor that in the system. Once that is done, you have the correct portfolio valuation. YIB, I usually do that. I'm on the tech side and also product side. I'm actually everywhere. So then future profit becomes easier. Remember, you're lowering cost, increasing the number of shares, because when you're buying lower, you have a chance of buying more shares. That increases your capital gains when prices go up. And also dividends, a very important dividend. Remember, dividends are paid per share. So with that, I'd like to thank you, and remember to subscribe for more. In the next one, now we go into more details and also why DCA doesn't work for penny stocks and why it works for dividend stocks. And remember, tutorials and notes are on my blog. I'll be updating with all these trainings so that if you want to read, you can read. Videos are available on my YouTube channel. Also, you can join the WhatsApp community. The link is in the description. TikTok, Facebook, Instagram, LinkedIn, X Discord where you are free to discuss anything.